with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, September 26, 2025, and welcome to the new season. That's right. No, not autumn. No, not Halloween. No, not earnings season. We're 2 weeks away from that. Good guess. No, welcome to government shutdown season, ladies and gentlemen. It is that time of year where the government likes to shut down because they're completely erratic and irrational and crazy over there in D.C. So that's the big threat right now. The government's going to shut down next week if they can't get their act together. I say let it shut down for 6 months, see if we can do without it for a while. I know I'm being facetious. We want people to get paid. We got a lot of clients that work for the government. But my point being, this happens so much anymore that the market doesn't even seem to really care. It kind of gets old. It looks really silly and stupid. But I've got some good news for you. If they iron things out between now and, say, next Wednesday, even if they shut down for a couple of days, they can iron things out here pretty quickly. We won't have to worry about this again until November. No. I mean, like 6 weeks from now, November. Yeah, that's right. Why this big kerfluffle over a temporary bridge to get us from point A to point B when the heavy lifting still has to be done? I don't know, but that's what's going on. Just noise for the market, so I wouldn't worry too much about it. There's other bigger things and other bigger fish to fry when it comes to Mr. Market. So what's going on this week? What happened? Markets pushed lower. No surprise. We talked about it last week. I said, look, I think we're going to have a delayed reaction on the sell the news event. The markets pushed higher, heading into the Fed rate cut last week. I expected that it could shape up to be a sell the news thing. Once we got that cut, the market would likely go down. It didn't right away. It kind of pushed higher for a couple of days, but that changed this week. I think some of that's because the Fed's out there reiterating what I heard very clearly from Fed Chair Jay Powell last week, and that is we're not so confident on what lies ahead when it comes to policy. It's going to be very data dependent because we are in a sticky situation. I mean, Powell pretty much said he's between a rock and a hard place last week. And the Fed folks are out there talking to the media, seem to reiterate that this week. And the market's starting to maybe wake up to that to some extent. And why are they between a rock and a hard place? Because the data continues to be pretty strong on some levels. So look, this week, if you look at some of the economic data, you had housing starts much higher than expected. You had GDP, initial read from the Atlanta Fed, 3.9% growth, 3.9%, almost 4% GDP growth. Now, some folks say you can attribute that to some of these trade things that have been going on, the whipsaw back and forth on tariffs, but nonetheless, it's a high number. And then the concerning part, the number one inflation metric that the Fed watches, the number one number, the PCE number, the Personal Consumer Expenditure Report, out today, year over year number, 2.9%. Now, the Fed wants to be at 2, okay? Can we round up a tenth? We're at 3%. We are not at 2. We are at 3. And the Fed is very concerned that missteps could lead to a resurgence in inflation, and you do not want to let that genie out of the bottle. So there's a lot of competing narratives here for the Fed. The market is, I think, over its skis with pricing in not just the next 2 cuts this year, but then 3 more next year. I think that's pretty aggressive. If we're going to get all these cuts between now and the end of next year, I think we're in a recession. I mean, there's really no reason to cut to that extent, and there's something bad going on. So the market's going to have to kind of work all of that out. And maybe we started seeing that this week with things pushing a little bit lower. When you look at the sectors, kind of mixed around the board. Most things were pretty weak this week, except for semiconductors and utilities. You can thank all of the AI talk for that. We'll talk more about that in a moment. And energy having a bit of a resurgence this week, up 3.9%. Looks like crude oil found a bit of a bottom and is pushing higher. Not sure how well that's going to perform over the next 6 to 12 months based off some of the technicals, but maybe in the short run, we'll see a little bit of a push higher there for oil stocks. And then on top of that, we've got gold and silver, and they just continue to be super strong. I think the world is really looking at gold and silver as the safe haven. We had bond auctions this week, and they didn't go that great. They just did not go very well. But gold was up 2.2% this week, silver up 7.2%. And our gold mining company, Kinross, continues to push higher. It's like 160% up year to date. We trimmed it a couple weeks ago, but it continues to push higher. Go ahead, double again, Kinross. We'll trim you some more. Keep going, buddy. Keep going. So what else is going on? What other things are happening in the markets? What's pushing things around? Some trade confusion. You think the tariffs thing is finally resolved, right? We've got everything kind of ironed out. The next big thing is the Supreme Court weighing in on whether or not it's legal, but you think it's resolved. And then we get more announcements from the Trump administration today, 100% tariff on branded pharmaceuticals that are being imported. I mentioned that to you a couple months ago. We were prepared for that. Maybe it wasn't quite 2 months, maybe 6 weeks ago. We had some extra pharma that we trimmed back on a little bit in preparation for this. So 100% tariff on imported pharma unless they are going to manufacture it in the United States. And I get what they're trying to do there. It's a bit of a security risk if you depend on China for your diabetes medication. I understand. And then today, there were additional tariffs put in place for heavy trucks, and they signaled more to come in regards to robotics and maybe industrial machinery as we're starting to take a look at those things. So we've got these big tariffs we've put on all these nations. And then on top of that, we've got these little industries that we're carving out and adding more. Now, if the trade deals that are in place have already locked in or carved out these industries for exceptions, then these new tariffs won't apply. But if these countries did not carve out exceptions for these areas, then there's going to be tariffs on top of tariffs. One thing I'm a little concerned about is the administration's motives. Listen, as long as you're trying to even out the playing field for America, you're trying to benefit American companies, use these things for leverage to try to, get things leveled out as far as trade is concerned, that's one thing. But if the main thing starts to become revenue generation, watch out, okay? Because history shows that does not end well. Tariffs for revenue's sake and revenue's sake alone just do not go well. So we've got to be careful that we don't overdo it and just shoot past this thing and be too aggressive on the tariff front. But right now, that's shaking things up a little bit. So I'll be watching that pretty closely. And then maybe the other big thing that's really moving markets more than anything right now has been AI spending. I was up at the New York Stock Exchange this week and invited to a group of folks to just some different panels, discussions on the markets today, where we're headed, how things look, et cetera. Great group of folks. I mean, I got to talk to some amazing people, Joshua from Lux Capital, Paul Isaac, Cameron Dawson, Mike Green, David Einhorn, this dude from Greenlight Capital. He's just a beast. He is like the Warren Buffett of our day. Brilliant guy. Great conversations across the board. I will say this, history doesn't necessarily repeat itself, but it often rhymes. And everyone kind of has their eyes on what's going on right now with this AI spending, the whole AI trade. It's looking really frothy. It's starting to become very reminiscent of the tech bubble back in the 90s. So then the question becomes, are we at 1995 or are we at 1999? Because if you're at 1995, there's a heck of a lot more money to be made. If you're at 1999, watch out. And it's kind of unclear. We're seeing some of the frothy signs of things that should make you concerned. Some of these dollar amounts are being spent into infrastructure on technology that's not even being monetized as of yet. The profit's not even there yet. Look, there's one company that was out there touting they're going to spend $1 trillion on data centers. And guess what? Guess what the revenue was this year? $10 billion. Well, how are you going to spend $1 trillion when you only made $10 billion gross? How are you going to do that, right? We're seeing all this money being dumped in from one company to another. Vendor financing is what we call that. We saw a lot of that during the tech bubble. So you got NVIDIA, the chip company, dumping money into their clients, right? Investing money into their clients' companies with the expectation that those clients are going to take that money and come back to NVIDIA and buy their chips. It's like circular money, just passing money from one person to the next, back and forth, back and forth. I write you a check and then you give me cash and then I write you a check back again. I mean, it's like a circular motion here. And we're seeing a lot of that kind of stuff and it's concerning. You've got Facebook which we own. We've got it in our models. It's done us well. We bought it for $150 back in 2022. It's at $742 a day. It's done very well for us. But they're doing some things that are a little like, that's reminiscent of the late 90s. They're using special interest companies to buy up these companies related to AI and stay under the radar of the federal government, just keep them out of the crosshairs for being accused of being a monopoly. Well, one of the companies that was notorious for doing that was a company called Enron back in the day. I think there's a big difference there. Facebook's got the capital to do it. Enron didn't. But my point being, there's a lot of crazy things happening. SPACs, special acquisition companies are coming to the market, IPOs like crazy, overvaluations. The private market, valuations are like just skyrocketing in the private market, private capital. I heard today one company, valuation a year ago was $1 billion. Today it's $30 billion. They don't even have a product yet. Now, that's not on the market. It's not public. It's a private company. But my point is this bubbly type of activity is really starting to spread. So there's a lot of talk about that this week. And one thing I'll say, I'm happy to hear so many folks feeling the way that I'm feeling, that this market can push higher, no doubt about it. But there's a lot of things to look at that are uncomfortable right now. A lot of things to make you feel uncomfortable, from valuations to cracks that you see in the economy, to the bifurcation we see in the economy, right? People that make a lot of money are spending really aggressively. Those in the lower end of the economy are really struggling right now. I think the wealth effect, the fact that the market has been pushed higher, has been helping make that happen because the wealthier folks have more money in the market. Market goes up, they've got more money to spend. If that narrative changes, watch out, because the lower end of the economy is not doing well. They're just not. And that's a concern. So a lot of these folks I talk to are sharing the same feelings that, listen, the market looks like it wants to go higher, but it certainly is uncomfortable. And there's a lot to be concerned about in there. And that's why I like what we're doing with the models right now. I mentioned last week, we've really shifted to trying to move the models to all weather investing. So if this market wants to push higher, if it wants to get frothy, if it wants to be irrational, fine, go ahead. We'll make money on it. Maybe not as much as we would if we were all in, so to speak, but we're going to make plenty of money. On the other hand, if the tide changes without people really noticing it, I think we're going to be okay. One of the things that was said on Thursday that I was like, yeah, well, that's not the way we're going to do this. One of the things that was said was, look, keep dancing as long as the music's playing, right? As long as the music's playing, keep dancing. Now, here's the problem I've got with that. Wall Street never seems to know when the music stops, okay? Wall Street thinks that when the music stops, they're just switching records. For those of you that know anything about spinning vinyl, right? You got to take one record off, put another one on, unless you're running two turntables at the same time, I guess. But my point being, Wall Street sometimes doesn't know that the music has stopped. They think there's just a pause in the action, and they stay on the dance floor for too long. And if you ever watch It's a Wonderful Life, the dance floor opens up and everyone falls into the swimming pool. And we're not going to let that happen here. We don't want that to happen here. So we are trying to kind of get ahead of this a little bit with our diversification, with some buffers. We could be a couple years early, no doubt about it. We could be in 1995, but we got plenty of exposure to take advantage of it if it goes higher, but we've got plenty of protection if things do turn and go the other way. I had some great conversations with the folks that manage our managed futures strategy that we have in the portfolios right now. Paisley Nardini and Charlie McGraw, fantastic, super sharp. I pushed back on them on a couple of things. They pushed back on me. Great conversation. I like what they're doing there. And I like their approach and how they are focused on execution, really, and staying very, very disciplined with what they're doing. So we've got the stuff in place that this market does get squirrely. We're protected. But a lot of folks are kind of thinking the same thing I'm thinking. The market can push higher. And I think it can. You just have to be a little bit more mindful at this stage in the game, in my opinion. Now, there's a couple of folks out there I think we're just getting started. That's great. Maybe we are. But I would rather err to the side of caution at this stage than to be too aggressive and get burned. So that's what we are doing. So I like how things look. For all you folks that have added money in recent weeks, we've been sitting on it. We haven't really been aggressively putting it in. We've added money to bonds. We've added money to the areas of the models that were underperforming, maybe out of favor on any given time here over the last month. But as we get a little bit more weakness in the broader market, we'll be getting that capital put back to work. I do think we can see this market push a little bit lower here between now and moving into October. That wouldn't surprise me in the least. So we want to make sure that we are prepared to take advantage of that. So that's what I've got for you this week. So between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Retire a little early, take that big trip, pay for college or wedding. Hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.